I'm Jono. Motley Fool versus Seeking Alpha. Let's compare.
One claims 975% average returns, while roughly 54% of its picks underperformed the index. The other had 27 people charged by the securities regulator for fake analysis on its platform and then charged subscribers over 500 after trials of roughly 5. One has 33 years with 0 enforcement actions and billing complaints across 3 countries. The other was not charged in the securities case and has the highest billing complaint volume in the series. One picks 2 stocks a month. The other has over 7,000 authors and a quantitative system backtesting at 139%. Both auto-renew at higher prices. Both make cancellation harder than sign-up. Both refuse refunds for unused periods. The curated picker versus the research hub. The question is, which billing pattern you are willing to navigate for the analysis you need? Motley Fool Stock Advisor was launched in March 2002 by 2 brothers who had built one of the most visited financial communities of the early internet era. The anti-Wall Street thesis was that individual investors could make better decisions with better information than expensive professional advisors provided. 2 curated picks per month. Buy great companies, hold through volatility. The methodology is genuine. The wealth management arm is registered with the securities regulator as a fiduciary advisor. 33 years of operation with 0 enforcement actions. In 2022, the securities regulator charged 2 outsiders for front-running roughly 60 recommendations over 2 years, generating over 12 million in illicit profits. The case targeted the outsiders, not the company, but it demonstrated the picks move markets significantly enough to generate that scale of profit from early access. The 975% average assumes equal weight across every recommendation since launch, held until a sell signal, with no taxes or trading costs. Almost no subscriber executes perfectly. Roughly 54% of picks have underperformed the index. A handful of extraordinary winners recommended early inflate the average. The launch near the bottom of a generational bear market created a timing advantage embedded in the long-term number. A simple large-cap growth index fund outperformed the service over the 2020 to 2024 period. The billing complaints are documented across 3 countries. Auto-renewal without adequate notification, price escalation from roughly 80 to over 200 without warning, refusal to refund unused annual periods, aggressive upselling from the introductory price toward a tier costing nearly 14,000 a year. A subscriber paid nearly 2,000 Canadian across 4 services in 3 weeks and lost money on most recommendations. The Canadian entity could not be located by the Business Standards Bureau, but the competitor with the crowdsourced model has a different billing pattern entirely. Seeking Alpha Premium was founded in 2004 by a former investment bank analyst who saw the structural failures of institutional research from the inside. The crowdsourced model lets over 7,000 authors publish original analysis. The quantitative rating system evaluates stocks across 5 factors and updates daily. In 2024, the strong buy ratings returned roughly 37% versus the index's 25%. In 2022, they returned roughly -1 versus -18, significant defensive outperformance. The breadth is unmatched in this comparison. Millions of articles, transcripts, data, and ratings in one platform. The publisher exemption, confirmed by a 2024 court ruling, means no fiduciary obligation to subscribers. In 2017, the securities regulator charged 27 people for paying writers to publish fake independent analysis on the platform. The platform cooperated. It was not charged. It enhanced its disclosure requirements. The per-view author compensation creates an incentive towards sensationalist headlines. The subscriber base's collective behavior is licensed to institutional investors as data. Subscribers are simultaneously the customer and the product. The billing complaint volume is the highest in this series. A subscriber signed up for a trial of roughly 5 and was charged roughly 500. Another was charged over 500 through a hurried phone process. A third was charged 239 7 months after confirmed cancellation. The standard subscription has no refund policy. 3 price increases in 3 years compound the impact on auto-renewal subscribers. The platform also operates a marketplace where individual authors sell their own premium services at $50 to $500 a month per service. A subscription within a subscription. Marketplace billing complaints mirror the main platforms. But the structural differences between what these two platforms sell determine which one fits the way you actually invest. The products serve different investors at a fundamental level. Motley Fool picks 2 stocks a month and tells you what to buy and when to sell. The value proposition is curation. Someone else does the research and hands you a conclusion. Seeking Alpha gives you the research infrastructure to form your own conclusions. Thousands of articles across every sector. A quantitative screening system. Earnings transcripts. The value proposition is breadth. One is a fish, the other is a fishing rod. The performance evidence differs in kind. Motley Fool's 975% is a backward-looking equal weight calculation that no individual subscriber replicates. Seeking Alpha's quantitative backtest at 139% cumulative is self-reported with independent bloggers, roughly confirming a general edge. Neither platform discloses what actual subscribers experience in aggregate. The gap between theoretical performance and real subscriber returns is undisclosed at both. The billing practices overlap but differ in severity. Motley Fool's worst documented case is a price nearly tripling on renewal. Seeking Alpha's worst is 100 times the trial price charged in a single transaction. Motley Fool's upsell architecture runs to nearly $14,000 a year. Seeking Alpha's professional tier costs $2,400. Both have documented post-cancellation charges. Both have documented refund refusals. The Federal Trade Regulator's 2024 rules require easy cancellation. Complaints at both platforms continued after those rules took effect. The regulatory records are the clearest divergence. Motley Fool has 33 years with 0 actions. Seeking Alpha had 27 people charged for using its platform to publish fraudulent analysis. Neither platform was itself sanctioned. The difference is that one has never been adjacent to an enforcement action and the other was the infrastructure through which a fraud was conducted. Motley Fool Stock Advisor for the long-term investor who wants curated stock picks from a 33-year operation with 0 enforcement actions and a documented methodology of buying exceptional businesses and holding through volatility, accepting that roughly 54% of picks underperform the index, that the most cited performance figure is inflated by a handful of early winners, that the billing practices are documented across 3 countries, and that the upsell architecture runs to nearly $14,000 a year. Seeking Alpha Premium for the active researcher who wants the broadest analysis platform in the series, with a quantitative screening system, crowdsourced sector expertise, and institutional-grade data access, accepting that the billing complaint volume is the highest in the series, that a trial of roughly 5 can convert to roughly 500, that the Purview author incentive rewards sensationalism, and that the subscriber base's behavior is licensed to institutional investors. At the introductory prices, both offer reasonable value. Set calendar reminders before renewal. Use a virtual card for any trial. Screenshot cancellation confirmations. Monitor statements after cancelling. The curated picker with the misleading average, and the research hub with the worst billing in the series. Both sell access to information that a simple index fund does not require you to pay for. The academic research on investment newsletters finds roughly 11 to 14% outperform long-term. Both of these platforms are in that group. The other 86% are not. Know that context before you subscribe to either one. Every choice is a trade-off. At least now you know what you're trading.